Let's start talking about trusts in general. How do these trusts work? What do they mean for your clients? What do they mean for you? What's their purpose? Trusts are really flexible documents. Attorneys love trusts because they are the most flexible way to control assets for long periods of time. I mean, we can be talking decades, we can be talking generations. There are all sorts of things that you can accomplish with trusts. Those of us who are income tax professionals, we don't like trusts so much because you have to read that stinking trust document to determine all that correct tax reporting. And that is one of the unfortunate things about the trust, because as we get into this, we're going to discuss the fact that the trust is the law, right? So the trust is what tells us how those items are taxed. It's not just our general income tax knowledge. And that trust document can be a pretty daunting document. There can be a lot of legalese in there. Sometimes you have to read those things over and over again to make sure you really understand what's going on. But unfortunately, you do have to read that trust document before you. Today, we're going to really touch on those general trust terms, what the trusts are for, what the benefits are that they provide to your clients. There's a list of those common terms. So the first term is trust, and a trust is just a fiduciary relationship. It's really just a document that sets up a relationship that says someone is going to control the assets. The trust is going to say where the assets go, and that trustee is responsible for maintaining those assets in the best possible way according to the terms of the trust. So that's one of the nice things about the trust is that people like, is that I can control my assets for long after I'm gone, right? I can say in my trust what I want to happen in the future, even though I'm not there to make sure it happens. So that's what that trust purpose is. We've got the settlor or the grantor. That's the person who creates the trust. So you might hear the term grantor trust from time to time, or the settlor put the assets in there. So the person who puts the assets into the trust, they're called the settlor or the grantor. Then we have a trustee. A trustee is the person who manages the trust assets. So they're really treated like the property owner. And it's interesting because we talk about litigious situations and, the trustee is the one who's in control. But I'll use my own family experience that we've been going through recently. So my grandfather passed away 2 years ago. He had 3 beneficiaries, my mom and her 2 brothers. My mom is the trustee of the trust and the executor of the estate. All 3 of them are beneficiaries. There's been a lot of fighting going on amongst them. And ultimately, my mom said to me the other day, well, this is ridiculous. I can do whatever I want to do because I'm the trustee and he can't stop me. And she's right. He can't stop her. And she isn't doing anything wrong. And she really is acting in all of their best interest. He's essentially just being a pain. There's been some fighting. And so he's trying to make it as painful as possible on everybody, doing things like setting up appointments to have moving vans come and then not showing up when he's supposed to be there. Could she go ahead and just sell the property that he doesn't pick up? She can. But then the question is he going to come back later and try and sue her because she didn't give him enough notice? She didn't do it properly. Even though she did, he can sue her, and that can be very expensive. So the trustee does have the authority to manage the trust assets, but that doesn't mean that the beneficiaries can't question it. Trust property, that is the assets that are in the trust. So anything that's held in the trust is considered trust property. It could be cash, it could be real property, it could be intangible assets. All of those items that are in the trust are considered trust property. And then we've got the beneficiaries. The beneficiaries are the people that the trust is established to benefit, right? So I might be the trustee and the beneficiary, like in my mom's case. All of the children are beneficiaries. One of them is also designated as a trustee. Okay, take a look there a little further down on page 1, and let's talk about the fact that a trust is what we call a fictitious person, right? So a trust is always a legal entity, but for our purposes, it's not always a taxable entity. And I think that's where some people, when we first start talking about trusts, there's some confusion. They don't really understand how it works. So the trust is always a separate legal entity. It might change over time. It might be revocable or irrevocable. And the terms of the trust determine whether or not it is a separate taxable entity. So if I set up a trust that is my irrevocable living trust, for example, yes, I do have a trust. My trust does control my assets, but it's revocable. I can take everything out. And so I am still the person who is taxable, right? All of the income from those trust assets flows through to me. If, however, I die and that becomes an irrevocable trust and those assets remain in the trust, now that trust is most likely a taxable entity. We're going to talk about situations where irrevocable trusts are not taxable entities as we get a little later into the materials, but always a separate legal entity, not always a separate taxable entity. So the question is, where does the income get reported, right? Is it on the individual's return or is it on a trust return? Now, trust can be created a number of different ways. If I set my trust up now, my living trust, for example, or even an irrevocable trust that we're doing for asset protection or something else, I have a declaration of trust or a trust agreement. So that's that long document that I put all of my wishes in currently. That declaration of trust establishes the trust at that time. We can also have a trust that's established as part of someone's will, right? So maybe I don't have a living trust, but as part of my will, it says that if I die and my children are still minors, I want the assets for them to be held in trust until they've reached 25 years of age, for example. So that would be a trust that was established as part of my will. And we can also have a situation, we're going to talk about bypass trusts and Q-tip trusts and things like that. So we could also have a situation where we've got a married couple, they have a living trust during their lifetime, and then when one of them passes away, that trust document designates separate trusts that are created after the death of the first spouse. So there are a number of different ways that those trusts can be created, but they are a separate legal entity. Now, trust can hold all types of assets, right? So we can really put anything we want into that trust. The trust can be a beneficiary of a life insurance policy, an annuity, or a pension. That's pretty common. We see that a lot. A trust, the one thing a trust cannot do, however, is be a joint tenant. Because the rule with joint tenancy is that the last surviving tenant is the one who gets to keep everything, right? Well, if we have a trust is never going to die. So the trust would always be the surviving joint tenant, and so it's not permitted to use a trust in a joint tenancy. Two, there's a discussion of the fact that the trustee has the rights and powers of a legal owner. So like we said with my mom earlier, yes, she is treated like the owner of the assets. She has full authority to sell them, but notice below that it says she must act in the interest of the beneficiaries. And that's where you can get into trouble because those beneficiaries can question you very easily. You want things to be transparent. You want to make sure that everyone understands why decisions are made so you're not stuck in a situation later where they question it. Because like Lynn mentioned, that $200,000 estate quickly racked up about $195,000 bill litigating those issues. So the trustee does have the rights and powers of a legal owner, but they are required to act in the interest of the beneficiaries. If self-dealing occurs, a trustee is going to have to prove that they're innocent. And that's always an interesting situation, especially where you have a trustee who's also a beneficiary. Are they acting in their own interest more than the other beneficiaries? So you want to watch out for that. Never have a situation where their actions can be questioned. Also a discussion of the different types of beneficiaries, because we talked about beneficiaries, right? And I said that the beneficiaries are the ones who get the assets from the trust. But remember that we have different types of beneficiaries. We have income beneficiaries. Income beneficiaries receive the income from the trust assets. Now, I mentioned earlier that the trust is the document, or the trust is really the law, right? So typically, let's say we had a stock, for example. We would think of the stock as being the principal, and any dividends that were received from that stock would be considered income. But the trust might designate that differently, right? So you always have to look at the trust documents. What does the trust consider income? What does the trust consider principal? Because the trust might have different income beneficiaries and different principal beneficiaries. If all the beneficiaries are the same, those items are not as important for distribution purposes, although they may be important for taxation of distributions, but that's a different story that we'll get into tomorrow. And then we have the remainder men. So the remainder men are the ones who get whatever's left at the end. So once we've gotten to the end of the trust term, whatever's left is going to go out to the remainder men. And you could have one person that falls into all three of those categories, 2 out of the 3. So it really just depends on the type of benefits that they receive under the trust. Like I said, the trust document is what controls, right? So we always look to the trust document if we're trying to figure out what is happening in a certain situation. However, if we have a situation where the trust is silent, then we look to state law. So if we have a question and the answer to that question isn't in the trust, we'll look to the state law. Here in California, that's the California Probate Code. If there is still nothing, then you would look to the Uniform Principal and Income Act or the Uniform Additions to Trust Act. Those are federal laws. And those things are really important for trustees. You know, if they're stuck in a situation where they don't know what they're supposed to do, you know, what are not just their rights, but what are they required to do for the benefit of different beneficiaries? And Lynn's going to talk to you about bypass trusts a little bit later, but that often becomes very important. We tend to see situations where bypass trusts are very vague, and the trustees are left in the situation of, well, what do I do? You know, who am I responsible for protecting, the current beneficiaries or the future beneficiaries? And so sometimes we have to look to those federal laws if we don't get answers from the trust or the California law. And you always, like I said, have to read that trust instrument to prepare the tax returns. There's a question that says, are beneficiaries entitled to receive a copy of the trust document or only the trustee? Yeah, the beneficiaries can receive a copy of the trust document. They're entitled to know, what they're allowed to receive. So you can go ahead and give them the copies of those trust documents. I've had this situation recently with my mom and my uncle who are arguing. You know, he's demanded certain documents along the way, and my mom will say to me, well, I don't have to give that to him. And in some cases, the answer is no, you don't have to give it to him. But especially when you're not hiding anything, always better to give them the documents that they're requesting so it doesn't look like you're trying to hide something, right? So we're not trying to make things more difficult than necessary. Amending the trust. Revocable trusts. So we have 2 different kinds of trusts. We have revocable trusts and we have irrevocable trusts. If I establish a revocable trust, that means I can change my mind. I can cancel the trust. I can change the trust. Here in California, the law is going to presume that a trust is revocable unless it states that it is irrevocable. If a trust says that it is irrevocable, it cannot be canceled or amended. So living trusts, for example, start out as revocable trusts. I can put whatever assets I want in, I can take assets out later. But under the terms of the living trust, once I die, that trust becomes irrevocable. So the general rule is going to be that a trust is revocable unless it states that it's irrevocable. And sometimes that happens from the date the trust is created, and sometimes it happens after an event occurs, right? So revocable versus irrevocable, and those become important when we're talking about estate planning and income tax issues. We've talked about the general terms of the trust. We talked about the fact that the trust is law, but really let's talk about the purposes that trusts are used to accomplish, right? Because we're going to talk about some different types of trusts as we go through the materials. We're going to talk about the income tax consequences, but really the question is, what can we do with a trust? There are a number of different goals that can be accomplished by using trusts. The biggest one, the one we see most common, the number one reason, particularly here in California, is probate avoidance. Probate is really cumbersome and expensive. So we always want to try and avoid probate. So even when we're not talking about a large estate, we want to have that trust to make sure that your clients aren't in that probate situation. So that's the number one reason why we see trust. Now, there are pros and cons to probate. So we'll talk about California's probate system because sometimes there are some assets that you want to go ahead and probate. And you want to make sure a trust is the best option for your client, right? Because a trust can be expensive. Now, I'm going to say, we talk a lot about companies like LegalZoom and the fact that it's really easy for clients to get their own legal documents taken care of. We talk about it a lot with regards to things like LLCs and corporations. We are also seeing it more and more with trusts. There's two things here. Number one, it makes the trust much less expensive, right? Because we could have somebody, they can do a trust on LegalZoom for around $300, and they can have their trust, their will, their advanced health care directive. They can get all of those things taken care of. However, keep in mind, they're not getting any legal guidance when they're using a website like that. They're not getting any additional information about whether or not these things are really the best for them. So, we're going to talk about how those things can be pros and cons using those websites as we go through the materials, but there are also pros and cons to probate. So we want to make sure that the trust is the best option for your client. It used to be a situation where sometimes the trust was really expensive and it wasn't necessarily necessary. We could do a joint tenancy on an asset rather than going to the expense of establishing the trust. But when we look at basis step up and things like Lynn mentioned earlier, very often that trust is a great tool. It avoids the probate. It doesn't have to be overly expensive. And it gives them some additional control over those assets. So let's talk about California's probate system. Basically, California's probate system is designed to transfer assets to beneficiaries while protecting creditors. All right. So in California, any estate that has probatable assets in excess of $150,000 has to be probated. Now, when we say probatable assets, we mean assets that don't have a designated beneficiary. So, for example, if we have a joint tenancy asset, we know that under the operation of the title, when the one joint tenant dies, the other joint tenant inherits it. So that is not a probatable asset. We know specifically where that asset goes at death. If we had a life insurance policy, for example, and someone is specifically designated as a beneficiary, that is not a probatable asset because we know who gets that asset at death. And that's why we say in some cases, people don't need a trust. You might have a situation where somebody doesn't own a home, their bank accounts, they have beneficiary designations on their bank accounts, on their retirement accounts. They don't have $150,000 of probatable assets. So we don't have to worry about the trust situation. But because of the value of real estate here in California, very often just owning a home creates a probate situation, and we see trusts very often just for that purpose. So if we have probatable assets in excess of $150,000, then we do have the probate. There are pros and cons to probate. Creditors have 4 months to come forward and state their claim on the assets. After that claims period expires, then the judge is going to approve an accounting of the assets and distribute them to the beneficiary, right? So the cons are, it's expensive. Probate, the estimates are that probate costs between 5 and 15% of the gross value of the estate. Here's the problem. For a larger estate, probably the probate cost is going to be a smaller percentage, right? Because the administration expenses. But remember that the larger estates are more likely to have a complex estate plan and less likely to have a probate issue. You often see the probate on a smaller estate where they didn't properly handle their estate plan. And we're not talking about a lot of money, but we are talking about a lot of administration. It becomes very expensive by the time we've paid probate fees, attorney's fees. So a big chunk of that estate can go to the probate. So it can be very expensive. It can take 9 to 12 months if there are no problems. Okay, so we're looking really at a minimum of a year when we've got a probatable estate. Everything can be contested. And by everything, I mean the appointment of the executor, any distribution, how the assets are handled, every single thing can be contested. And Lynn and I have been talking about those different family situations where people are not getting along. So remember I said if there's no problems, it takes 9 to 12 months. Now we're talking about a situation where bickering siblings can question every single thing that's done. So that's going to make it take longer. The executor is going to have to post a bond. There's a cost associated with that. Then we have a situation where if we have surviving family members that are still living in the home or need access to the assets, they're stuck with whatever's provided to them under the probate homestead and the family allowance rules. So their access to assets is severely limited. So there are some major drawbacks to probate, and that's why people want to avoid it. Now, that being said, there are also some potential benefits to probate. Lynn was talking about that situation where we had a $200,000 estate and it ended up costing $195,000 to litigate some disputes. And realistically, that happens because when we're talking about court cases, they can take years, right? And we're talking about a number of attorney's fees. Every time there's a phone call, there's a letter, any sort of conference, those bills just keep racking up. So it can be very expensive. The interesting thing about the probate court is that the probate judge can handle all of the disputes over the estate. And they tend to be very efficient. They're faster than judges hearing civil disputes because this is all that they do, right? So if we know that there's something that probably has to be litigated, probate might be where we want to do it because it's going to be faster and a little less expensive. I'm not saying it won't be expensive. I'm just saying a little bit less expensive. The probate is going to conclusively end all disputes. If the creditors are properly notified, they only have 4 months to file claims, and then if they don't, their claims go away.